Imagine you are standing on the sidelines of a test track, right? And you are watching this team of engineers unveil an absolute marvel of a vehicle.
Okay, I'm picturing it.
It is a race car that has been stripped of literally everything except a massive, just incredibly overpowered engine. Like, there is no heavy roll cage to weigh it down.
Right.
There are no reinforced bumpers. Honestly, the brakes look more than a little sketchy.
It's just terrifying.
Highly sketchy. But when that car hits the straightaway, it shatters every single speed record. I mean, it is blindingly, exhilaratingly fast.
Which looks like the ultimate definition of success, right?
Right.
Right up until the very moment it encounters a sharp turn or like a slick patch of rain.
Yeah, or even just a bit of debris on the track. That is the terrifying part. Because the moment the environment stops being absolutely perfect, that car does not just slow down.
It completely shatters.
It completely shatters. And that image, just a machine built entirely for acceleration with absolutely no design for survival, kept playing in my mind as we were pulling together the sources for today.
Yeah, it really perfectly captures the theme.
Because today, we are taking you, our listener, on a journey through a stack of materials that completely flips how we are taught to think about success.
We really do have an eclectic mix of sources to pull from today, and they all point to the same hidden architecture of success, I guess. We are pulling from the ancient financial parables of the richest man in Babylon.
A total classic.
Absolutely. We're laying that alongside modern financial philosophies from Rich Dad, Poor Dad, and the psychology of money.
Right.
And to really ground this in your everyday life, we're even folding in a highly practical workplace guide called 1 to 40 Tried and Trusted Ways to Become More Productive at Work.
Okay, let's unpack this, because our mission for this deep dive is to explore a super counterintuitive truth woven through every single one of those texts.
Yeah, the common thread.
Exactly. We are going to look at exactly why survival, like playing the long game, building a margin of safety, and avoiding absolute ruin matters exponentially more than getting rich or becoming successful as fast as possible.
Which is tough, because we are so conditioned by modern culture to just obsess over the straightaway. I mean, the messaging is all about the sprint, the hustle, rapid scaling.
Right. Move fast and break things.
Exactly. But if we want to understand the trap of that sprint, the psychology of money introduces a framework that breaks this down beautifully.
Yeah.
The author argues that getting money and keeping money are not just, different phases of wealth.
Wait, they aren't?
No, they are two entirely different, almost contradictory psychological skill sets.
Oh, wow. I mean, I guess that makes sense when you think about the posture required for each. Like, getting money requires you to be aggressive.
Yeah, highly aggressive.
You have to take risks, you need profound optimism to start a business or invest in a new venture, and you just have to be willing to put yourself out there. It is an offensive game.
But keeping money requires a defensive mindset. It requires humility. It demands this lingering paranoia that what you have made can be taken away by a market crash or a competitor or just, plain bad luck.
You have to assume things will go wrong.
Right. It requires a survival mindset.
Yeah.
The text makes this really poignant observation about the engine of modern capitalism. It is a machine that is exceptionally good at generating wealth, but it is equally good at generating envy.
Oh, man. And envy is the psychological mechanism that forces people to constantly move their own goalposts.
That is the danger right there. When you are surrounded by people who have more, the amount you have suddenly feels inadequate, no matter how much it actually is.
The sources give us some incredibly tragic examples of how this plays out in the real world. Let's look at Rajat Gupta.
Oh, yeah, this is a crazy story.
Right. So this is a guy who was orphaned as a teenager in Kolkata, and by his mid-40s, he becomes the CEO of McKinsey, literally the most prestigious consulting firm in the world.
Incredible success story.
He retires in 2007 with wealth most people literally cannot fathom. He had prestige, he had power, total freedom. I mean, he had won the game.
Yet he threw it all away. He literally went to prison for insider trading. And if we look at the why, it wasn't because he needed the money to survive.
No, not at all.
He was sitting on boards with billionaires, and his mere 100 million suddenly felt small. He lacked a sense of enough. He risked everything he had and needed to get something he didn't have and didn't actually need, purely to satisfy his ego.
It's wild. And we see the exact same destructive mechanism with the long-term capital management hedge fund.
Oh, the LTCM disaster.
Yeah. You have a room full of traders in the late 1990s, some with Nobel Prizes, right? Each personally worth tens or hundreds of millions of dollars.
Literally the smartest guys in the room.
Exactly. But in 1998, They took on staggering amounts of leverage, meaning they borrowed massive amounts of money to multiply their bets, just trying to squeeze out a few more percentage points of return.
And when the market behaved unpredictably, that leverage just wiped them out completely.
It is exactly like trying to sprint a marathon. You might lead the pack for the first mile, but you are going to completely collapse by mile 3.
This raises an important question. Why do incredibly smart, mathematically gifted people blow up their lives like this? Like, why do they sprint when they know they should pace themselves?
Well, let me push back on this a little bit, because isn't it just basic human nature to want to capitalize on a hot streak?
I mean, sure, it feels natural.
If you are counting cards at the blackjack table, or if your startup is suddenly going viral, or you're crushing it moving up the corporate ladder, every instinct tells you to press your advantage. If you are winning, why on earth would you hit the brakes?
Because the math of ruin does not care about your hot streak.
Yep.
And it really doesn't care about your confidence. When we consult the richest man in Babylon, which, by the way, is written about a society from 6,000 years ago, there is a very explicit warning against being misled by your own romantic desires to make wealth rapidly.
Romantic desires, I like that phrasing.
Yeah, the ancient wisdom states that the penalty of risk is probable loss.
Meaning the faster you try to go, the more fragile your vehicle becomes.
Yes. When you leverage yourself to the hilt to press an advantage, you are no longer making a rational mathematical calculation. You are letting your ego dictate your exposure.
You are trading your long-term survivability for short-term speed.
Exactly. If your downside is zero-like, if there is any chance you can be completely wiped out and removed from the game, then the potential upside doesn't matter at all.
So if the sprint leads to ruin, and running as fast as you can is actually a psychological trap, we have to fundamentally redefine what the finish line looks like.
We really do.
And this is where the sources transition from looking at wealth as a dollar amount on a spreadsheet to measuring it in a completely different currency, time and endurance.
It is a massive paradigm shift. In Rich Dad, Poor Dad, there is a reference to the inventor and philosopher Buckminster Fuller. And he had this fascinating definition of wealth.
What do you say?
Fuller argued that wealth is not your net worth. It is not the expensive cars sitting in your driveway or the designer clothes in your closet. Wealth is strictly a measure of your survivability.
Oh, wow. And the mathematical formula for that is so incredibly clarifying. It simply asks, if you stop working today, how many days forward can you survive on the cash flow from your assets?
All right, let's break that down. If your living expenses are, say, $2,000 a month, and the assets you own, maybe it's rental income or dividends, generate $1,000 a month.
Okay.
Your wealth isn't a massive dollar figure. Your wealth is exactly half a month. You can survive for 15 days. The psychology of money reinforces this mechanism by arguing that the highest dividend money pays isn't buying more stuff.
What is it?
It's controlling your time. It is the ability to wake up and say, I can do whatever I want today.
But to get that dividend, you really have to accept a reality that flies in the face of literally everything social media teaches us.
Oh, completely.
Wealth is actually what you do not see. It is the luxury car you decided not to buy. It's the first-class upgrade you declined. It is the kitchen renovation you postponed.
Because the mechanism of buying those things destroys your survivability.
Right.
Once you buy the luxury car, you don't have the money anymore. You just have a depreciating piece of metal.
Right. Stuff doesn't give you days forward.
Exactly. The text shares the story of an ER doctor with this brutal, high-stress job that constantly scrambled his circadian rhythms with night shifts. But instead of buying the massive house and the sports car to signal his status to the world—
Which a lot of doctors do.
Yeah, they do.
Mm.
But his family maintained a high savings rate and lived well below their means.
They bought their independence instead of buying stuff.
That is the trade-off.
Yeah.
After 2 decades, he didn't have to wait for traditional retirement age or hope for a pension. He just quit. He had accumulated enough days forward to simply stop and move to the next phase of his life on his own terms.
So what does this all mean? For the listener who is sitting in their car or on the train right now, maybe they are just starting out in their career. Or maybe they feel entirely stuck in what the sources call the rat race.
Which is a very real feeling.
How do they practically start building the survivability when they are just trying to pay this month's rent?
That is the pivotal question. And answering it requires us to move from the abstract philosophy of survivability to the actual daily mechanics of defending yourself against financial threats.
Okay, so what are the mechanics?
Surviving means managing your own psychology, specifically your fear, and building what investors call a margin of safety.
And the primary mechanism for that margin of safety is your savings rate.
It is the only mechanism you fully control. Look, people often fail because they rely solely on a single paycheck to fund their short-term needs. That is a single point of failure in the system.
Yeah, one unexpected bill and you're wiped out.
Exactly. To survive, you have to prioritize your savings rate over your income, and definitely over your investment returns. Think about it. Your investment returns are dictated by the global market, which you cannot control.
Right.
Your income is often dictated by your boss or the broader economy. But your savings rate, which the text brilliantly defines as the gap between your ego and your income, is 100% in your control.
That phrase, the gap between your ego and your income, is just an absolute gut punch.
It really is.
It highlights how much of our spending is just status signaling. It actually reminds me of the concept of fort assets from Rich Dad, Poor Dad. The author describes defending his asset column like a medieval soldier defending a fort.
I love that analogy.
Right. For anyone unfamiliar, your asset column is simply the things you own that put money in your pocket without your daily labor. Stocks, bonds, real estate.
Things that earn while you sleep.
Exactly. And the author points out a critical behavioral difference. People with fragile financial habits dip into their savings or sell their assets to pay their everyday bills or buy consumer goods. But people with a survival mindset know that savings are sacred. They are only ever used to acquire more assets.
Which perfectly echoes a foundational rule established 6 millennia ago in The Richest Man in Babylon. The very first cure for a lean purse is start thy purse to fattening.
Start thy purse to fattening.
Yes. And the mechanism is incredibly straightforward. Out of every 10 coins you earn, spend only 9. You keep at least 1/10 of everything you earn for yourself before you pay the landlord, the grocer, or the tax collector.
It is paying yourself first as a fundamental rule of survival.
What's fascinating here is how the psychology of money updates this ancient rule with a really clever psychological trick. We are usually taught that we need a specific reason to save, right? Like you save for a down payment or you save for a new car.
Yeah, every bank account has a little goal attached to it.
Exactly. But the text argues that saving just to save provides a massive hidden return.
Because it buys you flexibility.
Exactly. If you have a pile of cash sitting in a bank account earning virtually 0% interest, it might actually be generating an extraordinary return for your life if it gives you the flexibility to walk away from a toxic boss.
Oh man, that is invaluable.
Or the freedom to take a lower paying job in a field you actually love.
Right.
Or the capital to jump on a massive investment opportunity when everyone else is panicked and desperate during a recession.
But getting to that point requires facing down a lot of fear. There is a great analogy in Rich Dad, Poor Dad about a friend's wife who is an ER nurse.
Oh, this is a great story.
So when she sees blood spurting out of a patient in the trauma ward, she doesn't panic at all. Her training kicks in and she springs into action. But when the author mentions investing in the stock market, she gets terrified and literally runs away.
Right.
Conversely, the author admits he passes out at the sight of blood, but he can face a terrifying, volatile financial market with a completely steady hand.
We're all cowards at something.
Yes. The fear is natural, but the text gives a cheat code for those who are terrified of financial risk.
Right.
If you hate risk and you hate worry, the solution is to start early. Handling your financial fear by starting early, playing it safe, and just putting away that 1/10 consistently is the ultimate survival tool.
And this brings us to the most crucial phase of our deep dive. Like, why go through all this trouble to survive? Why build the margin of safety? Why relentlessly defend fort assets?
Yeah, what's the payoff?
Because surviving short-term volatility is the strict, non-negotiable prerequisite for unlocking the absolute magic of long-term compounding.
Here's where it gets really interesting. Because compounding is notoriously impossible for the human brain to intuitively understand. We think linearly, but compounding works exponentially.
We tend to think that good investing is about finding the next big thing and earning the highest possible returns every single year.
Beating the market.
Right. But the sources point out that chasing the highest returns usually involves taking on catastrophic risk. Those are one-off hits that cannot be repeated. Good investing is actually about earning pretty good returns that you can reliably repeat for the longest period of time. You have to avoid ruin at all costs so that time can do the heavy lifting for you.
And there is no better example of time doing the heavy lifting than the mind-blowing statistic about Warren Buffett. The sources point out that out of Buffett's $84.5 billion net worth at the time the book was written, $81.5 billion of it came after his 65th birthday.
Just let the mechanics of that sink in. The vast, overwhelming majority of his wealth wasn't because he was necessarily the greatest stock picker of any given year. It was because he survived.
Right.
How did he do it? He didn't panic and sell everything during the 14 recessions he lived through. He didn't use extreme leverage that could have forced him into bankruptcy. He didn't burn out and quit. He stayed within his circle of competence, and he just stayed in the game.
You can really contrast that survival instinct with another legendary investor mentioned in the texts, Jesse Livermore. In the early 20th century, Livermore was arguably better at timing the market than anyone.
He was a genius at it.
He became incredibly wealthy during the 1929 crash when everyone else lost everything. But that wealth made him feel invincible. He lost his margin of safety, he started taking bigger and bigger leveraged bets, he lost his survival instinct, and ultimately he lost everything and took his own life.
It's incredibly tragic.
It reminds me of the metaphor from Babylon that wealth grows from a tiny seed, like a tree. Compounding is like planting an oak tree. Having a survival mindset is just making sure you don't accidentally run it over with the lawnmower while it is still a fragile sapling.
If we connect this to the bigger picture, this survival mindset, this intense focus on endurance over pure speed, isn't just about your investment portfolio. It applies perfectly to your daily work, how you manage your energy, and your overall career trajectory.
That makes total sense.
Because if financial ruin is bankruptcy, career ruin is burnout. And the mechanics of avoiding both are shockingly similar.
Which is exactly why we brought in that productivity guide, 1 to 40 tried and trusted ways to become more productive at work. We usually think of productivity as just getting more things done faster, but the guide makes a really sharp distinction between efficiency and effectiveness.
And that distinction is the difference between surviving your work week and burning out by Wednesday.
Mm-hmm.
Efficiency is just speed. Doing a task as fast as possible with minimal wasted effort. But effectiveness is doing the right thing that actually moves the needle.
You can be highly efficient and completely ineffective at the exact same time.
Yes. The guide uses a brilliant, simple analogy to explain this. Imagine you need to pick apples from a tall tree in your garden. You go up to your second-floor bedroom where your tools are, and you build a high-quality ladder.
Okay.
You use the best wood, you work incredibly fast, you don't make a single mistake in the construction, you are highly efficient. But then you turn around and realize the ladder is fully assembled, and it's way too big to fit down the staircase.
Oh, no.
You have to dismantle the entire thing and rebuild it outside.
Yeah.
You were completely ineffective because you were sprinting without planning for the actual objective.
Building the ladder in the bedroom is the workplace equivalent of the race car without brakes.
Exactly. Just as taking on too much financial debt can cause a wipeout, taking on too many tasks at work without clear priorities causes an energy wipeout. You are borrowing energy you do not have, and you are burning your future days forward. To survive in your career, you have to protect your principal, which, in the workplace, is your mental energy and your attention.
The productivity rules in the source material are basically survival tactics for your work life. Take the rule about taking breaks. It sounds like a cliche, but the text really digs into the mechanism. When you are fatigued, your decision-making degrades.
Right.
The marginal utility of your work literally drops to zero. Pushing through exhaustion isn't heroic. It is like investing on margin. You are borrowing tomorrow's energy to fund today's tasks, and the crash is going to hurt.
Another crucial survival tactic from the guide is identifying what it calls incrementalists. These are the people in your office who come to you with a seemingly tiny 5-minute request.
We all know them.
Right. But once you agree, they drip feed additional requests one by one, slowly expanding the scope until they have stolen your entire afternoon and ruined your focus.
Oh, I hate that.
To survive, you have to defend against scope creep. You have to force them to clarify their entire objective up front. You literally have to defend your calendar the exact same way you defend Ford assets.
Which ultimately leads us to the most powerful tool in the productivity dictionary. And it is a 2-letter word. No.
It's the hardest word to say.
It really is. But the guide warns that if you become the eager point person for every single new task or committee, you will sink. Saying no isn't about being unhelpful or lazy. It is about opportunity cost. Every time you say yes to something trivial, you are implicitly saying no to your primary high-value tasks. You are giving away your survivability.
Whether we are talking about your bank account, your investment portfolio, or your daily calendar, the underlying principle remains completely intact. Protecting your principal, whether that's your cash reserves against a market crash or your physical well-being against a demanding boss, is the only way to stay in the game long enough to let compounding do its work.
Yeah.
If you burn out at 35 because you couldn't say no, You lose the massive professional compounding, the reputation, the senior roles, the wisdom, all that happens in your 40s and 50s.
You literally lose the career equivalent of Buffett's post-65 billions.
Exactly. Survival is the absolute prerequisite for long-term success. You cannot win if you get forced off the board.
So, bringing this all back to you, our listener, we have covered a massive amount of ground today. We have traveled from a 6,000-year-old clay tablets of Babylon through the psychological minefields of modern investing, all the way to how you manage your inbox and your energy on a random Tuesday afternoon.
It's been quite the journey.
And the through line connecting all of this is incredibly clear. The secret to profound, lasting success isn't about strapping a massive engine to your life and driving with no brakes. It isn't about moving the fastest or keeping up with the people around you.
No, it's really not.
It's about building a margin of safety. It's about defining your own personal sense of enough and ruthlessly defending that definition against a culture that constantly demands more. It's about recognizing that keeping what you have, your money, your time, your sanity, is a completely different and far more vital skill than acquiring it in the first place.
It is about consciously engineering your life so that you can survive the inevitable sharp turns, the slick roads, and the unexpected obstacles without shattering.
So we want to leave you with a final thought to mull over as you go about the rest of your day. We spend so much of our time and energy obsessing over what we need to start doing to get ahead. We are always looking for the new life hack, the new investment strategy, the new side hustle to sprint faster.
Always looking to add more.
Right. But based on everything we have looked at today, from ancient parables to Warren Buffett's billions to basic workplace survival, ask yourself this. What is the one risky, ego-driven thing you need to stop doing right now just to ensure you stay in the game until tomorrow? Because if you can't survive the track, the speed of your car doesn't matter at all. Thank you so much for joining us on this deep dive. We'll see you next time.
Thanks for listening. Stay safe out there.